But now let's go to something else, because gold and foreign exchange reserves were always part of international finance. So if we have to go through the different levels of financial contingency, or sometimes this is also called as financial safety net for countries, then obviously stage 0, when things are working well, so we have market-based debt financing or refinancing from the capital market. So banks, bond markets are doing their job well. We have no need for consolidation or bailout or anything like this, and also the state is healthy in terms of funding. So we can mobilize domestic savings in domestic currency to maintain our lending operations, and the problem can be that also we can mobilize foreign savings in foreign currency, but at least these are available for us. So we can see through the balance of payments, financial account portfolio investments, and also the motivation here will be obviously the gain on the uncovered interest rate parity, and also real gain. So when we are dealing with inflation, so compensating with inflation, still if we can realize higher returns on lending or on bond holding, then capital will flow in, so carry trade activities can maintain such an inflow of capital. But if they are not working, then we need the non-market based channels. So these are the different layers of the financial safety net, what we have today. So obviously in the good old days when central banks were created, they just had gold reserves. So if you had gold reserve, then you were able to stabilize your economy. If not, then sad moments happen. After the Second World War, people realized that, okay, foreign exchange reserve can be also really good, because they are paying some interests. And also, from this, if we have any problems with capital import, then at least expiring foreign currency denominated debt, so short-term foreign currency denominated debt, can be renewed from this one. So we can repay for external lenders, and also the bank is not collapsing because of disappearing funds from the liability side. So we can say that altogether gold and foreign exchange reserves are called as international reserves. This is a new thing, so foreign exchange swap lines, at least in the broad application since 2008, this is a new thing. Next week we will talk about it. And regional financial arrangements, there is a huge variety of them. I will talk about it maybe next week, maybe after that. Depends on the time. Because many countries created their own since the 90s. For example, this one is just for the Eurozone, and it's already quite flexible. So at the beginning, they just created it for stabilizing different member states' bond markets by collective bond issuance. Nowadays, they are using it for everything, just to collect funds through bond markets. Because in this case, the whole Eurozone issues bonds, not just one country. So in this case, investors cannot cherry pick to finance who. And also we have the International Monetary Fund since the Second World War, because they realized that we need something to provide loans for governments on medium run. And also in this case, central banks can also put some of their foreign exchange reserves as a deposit into the IMF. So in this case, they can operate or avoid contagions, so propagation of different crisis situations. So today I would like to go through gold reserves and foreign exchange reserves at least, because this is on our menu. So first of all, gold reserves. This can be absolutely familiar for you because 2 topics ago we started with gold, how useless it is as a currency, but otherwise as a reserve asset it can be quite popular, so we can still say that 70% of central bank ownership is present in the gold market. Also we can see that this is a safe haven asset, so if any exogenous shock happens, then gold prices are increasing. CAP and beta today, I was too lazy to calculate this one, to estimate it. Also it would be really hard to say that, okay, what is the market portfolio for a commodity? So it's S&P 500 would be not the best indicator, so that is not to deal with this one. But from monetary policy point of view, we know that this is on the asset side and this is part of the international reserves. But it has no interest payment, so our position completely depends on the market-defined price of this commodity, but also the benefit that from all domestic currency issuance we can buy gold, so we don't need foreign denominated liability to back this one. If you are looking on the global gold reserve data, then you can see. So these are the 50 most relevant economies. On gold.org, this is a free database. After just signing in with your email address, then you can see it, but I do the math, and then we can see that Eurozone has a lot, the USA has also a lot, and after that we can see that other countries has smaller amounts, so I also created a much more visual pleasing table from this one, so we can see that altogether the Eurozone has a lot of gold. If you are adding all other EU member states, then we can see that it's even bigger. But also, for the Eurozone or for the US, it's quite hard to create international reserves because your currency is usually used as a reserve currency. So that's why it's quite natural that they should keep something. And so the Eurozone can keep US dollar, the United States can keep euro and other currencies, but they cannot keep their own currency denominated debt as foreign exchange reserve, so they need something foreign. So that's why we have these ridiculously high numbers in percentage of the gold within the international reserve, because they have nothing much to do. Also, now it became really popular to purchase gold. So from 0 in Hungary, we were increasing it to this tonnage. Doesn't matter. So they are just diversifying their international reserves. Also in Czechia, they are also increasing it. They would like to increase it also to 100 tons. Yeah, it's nice, shiny, but at the end of the day, doesn't pay anything as an interest revenue. So sometimes I don't know why they are doing it. If we are checking within the Eurozone, we can see that mostly Germany prefers gold, or Italy, or France, and after that the rest keeps some. So Netherlands, or we can see here the ECB. So they have this 500 tons of gold, and they are doing it since it was created. I don't remember a case when they were purchasing any gold. Okay, they were purchasing many things, so they have really colorful portfolios, but not because the gold holding was extended at all. So if we are checking in the balance sheet, then this is the gold reserve value, and this is only because gold prices were increasing, not because they were purchasing anything. Even there was a custom during the early 2000s that central banks were selling. So during the whole 80s and 90s, central banks were just selling ad hoc their gold reserve because they realized that gold is not backing the money anymore, and it was much more lucrative to keep government bonds in denominated in key currencies. So the problem was that in this case it was destabilizing also the market, that suddenly huge sales orders were happening on the market. So obviously what they did is completely illegal for retail clients. So they created their own cartels. So they defined how much gold can be sold in 1 year, or at least for the next 5 years, and they kept the tonnage here. So after that they did the same thing in 2004. But we can see that once the crisis arrived, then nobody started to, or was so, it was not desired anymore to sell gold, but it was really popular until 2004. So still we can see some central banks which were selling. But after that, they discontinued the whole procedure. So they were saying, oh, let's forget about this. Because many central bank purchased so many things that now it was not fancy sell it anymore. And if you are checking the modern era, then we can see that now they are purchasing it back. So it's like a cat. At night wants to go out, and once you are allowing to go it out, then it would like to come back again and purchasing a lot of things. So if you are checking gold price change, then we can ask the question that, okay, we were able to see here countries, or I don't know what is the Eurozone, so economic integrations, which were absolutely happy to purchase and keep gold. But does it have any impact on the currency? Which is, we can say it's backed by gold, but still it's on the asset side of the central bank, so the asset side should back the currency on the liability side of the balance sheet of the central bank. So from accounting point of view, we could say backed with a lot of quotation marks. And in this case, we can say that absolutely not. So if you are just checking that what happened, so this is the base week, so this is a weekly data set, and compared to the base week's 100%, then even Swiss franc, US dollar, or Chinese renminbi was depreciating against gold. And also we can see the similar thing happened with euro, US dollar, Canadian dollar. Okay, somehow this is not US dollar. This is euro, Canadian dollar, but this is Australian dollar. Just for Japanese, yeah, it should be Japanese yen, not Australian dollar, because Japanese yen is yellow and it's there, but it's not mentioned. So we can see that, yeah, Japanese yen was also depreciating against gold, and also if we are checking Indian rupee, and also I did the Ghana cedi, because Ghana is a key gold miner economy and exporter economy. So I wanted to check that, okay, what happens if we are hunting this country. But unfortunately, in the case of Ghana, there was the problem of the banking crisis, and which again, so if we have endogenous issues within the economy, then gold is absolutely useless to measure it. Also, I calculated the risk. So we cannot say that gold is a risk-free asset until we cannot use gold for payments. So the same thing valid for any cryptocurrencies. Until I cannot buy bread or finance companies by the issuance of crypto something, or in this case gold, or cannot do foreign trade in this commodity, then it will be risky because its price will fluctuate. And we can say that this is a really good shock indicator. So whenever the conditional volatility was increasing, then we had some kind of a crisis situation. So also, if we are fitting a VGR gauge model, which I was teaching it last week on risk management in finance class on the second year master students, then we can see that, okay, mostly we can model these three things. So first of all, volatility persistence. So last week, volatility, so how uncertain was the market about pricing this asset. It's absolutely dominating what happens with this week. So if they were uncertain last week, then they will be also uncertain this week by 71 to 92%. The remaining will come from a random shock. So we can say it's somewhere between 6% to 14% will come from this shock. And also we have asymmetry. So whenever the gold price increases, then the volatility of this price will also increase. So it's always negative. Also the indicator. And even in the case of Swiss franc, which is supposed to be a safe haven currency, then still we can see the same things. The nu and lambda, they are just defining the asymmetric student distribution. So we are just defining the nature of this shock here in alpha denominator. So yeah. Next thing is foreign exchange reserve within the next quarter of hour. So foreign exchange reserves are really good because they're supposed to pay some kind of an interest. So they are always liquid assets in a high quality assets. So usually the maturity is less than 1 year, and they should be invested in something which is AAA rated, AA rated, sometimes single A rated, but that's the best. Also, it should be claims against non-residents. So it should be issued abroad. It cannot be issued by domestic actors. Or it should be also available for the monetary authority, so it means that it should be in their balance sheet. And the denominated in foreign currency, obviously, because this is foreign exchange reserve. And it's a portfolio always of financial assets. But what matters that liabilities are not deducted. So it means that if I need my foreign exchange reserve, let's say US dollar, then also at the same time I can issue bonds in US dollar to finance this, to collect these US dollars. And this defines the key problem here, because obviously even worse. Let's go back to this one. So, if we are the central bank, and let's say that I'm issuing a euro-denominated bond, which is for a AAA rated governments, it's around 4% of an interest. But if I'm buying German government bonds, their interest is around 2%. So the numbers are really low, but still we can say that we are losing on each euros, we are losing 2% of interest. So this is a natural limitation or natural barrier, and also a disincentive to create really high foreign exchange reserves from debt, because in this case these losses must be compensated from somewhere else. So all my domestic operations should make this missing 2%, and that's why naturally I will have higher domestic interest rates, because I have to earn this money. Also, we can earn this money if our currency is following a fixed exchange rate regime and our balance of payments is in a surplus, so trade account is in surplus, which means that we have to continuously purchase purchase foreign currency, and it means that it will land in the foreign exchange reserve. On the asset side, so in this case we are doing the funding in domestic currency. Just in this case we have to remove this domestic currency, this excess liquidity, because it would create inflation. So that's why we will forcefully sell some bonds to the banks to sterilize this excessive liquidity. So it can have two ways. But why to hold foreign exchange reserves? So if we need currency liquidity to finance government transactions, so whenever our government is paying for the lease fee for our Gripen jet fighters for the Saab concern in Sweden, then this is when we are getting our euros from the central bank, and then we pay. Or the new locomotives, which are leased also by the government, then they can be also funded through foreign exchange reserves. Obviously, this is not the primary usage here, just this is one task. Maintaining a mixed exchange rate regime or target zone. Obviously, if we have any kind of a fixed or pegged regime, then we need something to be, some kind of reserve to avoid depreciation. So intervention capability is necessary. Financing balance of payments, providing buffer for balance of payment shocks. I don't like this at all, because balance of payment shocks, so if you have to finance import, we are already in trouble, but mostly balance of payment shocks is happening at the level of portfolio investments. So this is where banks can take up loans abroad, this is where we can issue bonds abroad, so practically short-term debt instruments. Expanding the set of domestic monetary policy instruments. If you have really low public debt, this can be a problem. Usually we don't have much countries which has this issue. Increasing national wealth, generating revenue. Generating revenue by investing in US government bonds at 0 or 1% interest rate. Not the best way to generate revenues, but okay, we can understand that this can be also a motivation. Lender of last resort in foreign currency. Next time we will have a class or a topic about this. Ultimate resources for extreme global financial collapse. Okay, that's why we have IMF, because this is absolutely not enough. Mandating liquidity shortages on the foreign swap market again. And of course, first, but this is highly important, that we have to calm down our investors. So this money is on the table. If you need this, you will be paid. But we will never use this up, hopefully. So, because all the other things must be failing also at the same time. So mostly this is just an international collateral. This is like an option that if you are providing us a loans, and if it's not paid, then you have the chance to get money from this one, but hopefully we should not use this. Okay. Then obviously the question is the adequacy. So how can we decide that this foreign exchange reserve is adequate or enough or not enough? The Guidotti Greenspan rule was created during the late 90s, when people realized that usually we have to survive for several months. Because sooner or later IMF and all the other international agencies will arrive and provide you liquidity. So in this case, people were saying that, okay, only short-term debt should be covered, short-term foreign currency denominated debt should be covered, so which expires within a year. The problem is that the short-term debt can expire, or sorry, the size of short-term debt can change quite fast. So from 1 year to another year, which can make challenges. And also the other problem is that in this case, not just public debt, but also private debt is there. So, okay, in the case of banking system, central bank sees this. In case of companies, it can have issues. So this is not that well defined as it should be, but still the Guidotti rule is mostly preferred. So right now, today, already during the 2000s or 2010s, it was the most used version, because focusing on the gross external debt, that would be absolutely overkill. So by checking that what is the external debt, maybe it will expire within 40 years. No, we don't have to cover it because it would create enormous problems, and also we don't even have enough high quality assets to put into central bank balance sheets to cover all this external debt. So it's nonsense. M2 based indicator, in this case, this is a cute one because it says that M2, which is the broad money, 5% to 25% should be covered with foreign exchange reserve. This is a cute one because this is similar to the gold standard. There are also some percentage of the money in circulation have to be covered with gold. In this case, we extended this rule, so everything, so bank savings with maturities less than 2 years, 5 to 25% of them should be covered with foreign exchange reserve. So it's quite funny. Import rule, luckily, so this is an ancient one, and luckily nobody have to focus on this one until we have a globalized economy, at least. So this is for North Korea or other hermit economies when you don't want to do any foreign trade, or you are not allowed to do any foreign trade because you did nasty things. So in this case, then you have to cover at least 3 months of import, because in this case you can survive the next winter. So for things like this, so import rule. Unfortunately, students on the exams always remember on this one, but otherwise this is the important. So I don't know why this is happening, because I think it's simple to remember. But if we are checking different rating agencies, we can see that Guidotti, so the short-term external debt is relevant. M2 rule is also relevant, but the rest is not relevant at all. If we are checking different currencies as reserves, okay, in this case the ECB collected all the other features, but if you are just focusing here, then we can see that even if people are aging that, oh, the US dollar age is over and nobody cares about the US dollar anymore, yeah, 60% of the foreign exchange reserves, more than 60% in international debt, 50% in international loans, more than 50% in international deposits, and foreign exchange turnover, nearly 90% is happening in US dollars. So when we are drinking beer with friends, there is always someone who tries to come up with this one, that the era of US dollar is over. And in this case, I just look for this picture and show them. Yeah, I'm waiting for it, but it's far away. Okay, sometimes they are working on it, but we can say that. Second one is obvious, the euro, because this is a scrap together thing of West German mark and French brand and all the other things here. And after that we can see Japanese yen or renminbi. If you are checking the time series, if you are interested in this topic, there is a really good Excel sheet on the website of the IMF. I have to reconvert everything to annual data because also they have quarterly data, so it's a really strange data sheet, but okay, we can work with this. So we can see that yes, US dollar and euro. Sometimes it's okay, we can see that US dollar is shrinking from 70% in 1999 to nearly 60% today, but they were doing it or maintaining this position with nearly 0 interest rates since 2007. So yeah, that's I'm suspicious. Also in the case of euro, we have also nearly 0 interest rates here after 2009. So, and they are the remaining currencies like pound sterling, Canadian dollar, Chinese yuan, and so on. So if you are just checking the small ones, then we can see that Japanese yen was shrinking, now it's increasing. I don't know why. Okay, now they have also positive interest rates, but not that much. But I absolutely have no idea how British pound is still existing on the graph. But okay, some people are still preferring it. There are other currencies. There is Canadian dollar, Australian dollar, so commodity exporters. Again, Chinese renminbi. And the mighty Swiss franc is still with us with 0.00 something, but at least it's visible. It doesn't even have interest rate. So, I don't know. Okay, so advantages of being a reserve currency. So first of all, it's really good because you can just throw out some of your public debt to other countries and they will be happily buying it. So usually this is not the case. That usually you have to look for buyers to get your external funding if you have insufficient domestic savings. In this case, you are just printing government bonds and they are buying it like candy. So it's nice. So in this case, that's why, okay, I have many different reasons to not like public debt to GDP ratios because they are a terrible indicator for public debt sustainability. And this is also one case that this doesn't capture any of this fancy and sophisticated thing that you are just serving it out as a meal for foreign central banks to buy. And also, as we can see here, this setup tolerates low interest rate environment completely well. So even if we say that, okay, now central banks are trying to diversify, so they started to purchase gold in huge quantities, but you cannot convert all these things because there is not enough gold in the planet to convert. So also it's really hard to liquidate such a portfolio without appreciating the former reservist currency. So people are saying that, okay, but what happens if China sells their US dollar reserves? You can do it, just in this case, Chinese renminbi will be exploding in terms of appreciation. So the reason why they have the largest or biggest foreign exchange reserve is because they were keeping the Chinese renminbi's value artificially at an undervalued level. So if you are checking all the current account balance, then we can see that it should be way stronger than this one. So if you are converting everything, then you will appreciate Chinese renminbi. You can use it as a weapon, just this weapon also will destroy you. Same thing happened with Japan, that during the 70s they were building the biggest foreign exchange reserve, and since then they are just sitting on it. Okay, they have it. Also, there is a scarcity of AAA, AA rated economies, which would be good targets for foreign exchange reserve. So it's also a scarcity in terms of market. And also, there is another question usually which is coming up during beer drinking events, that what happens if China will start to issue bonds, or what happens if Chinese renminbi can it become to the new reserve currency? And first of all, they should sell government bonds. Can I buy Chinese government bonds right now with my phone? I cannot, because practically it's not impossible, but it's really hard to buy it, not just for small retail clients like me, but also on the wholesale market for investment banks or for insurance companies and so on. So I cannot invest into their government bonds, which means that also for central banks it will be really hard to acquire this. Or even if we can get it, so somehow miraculously we have a package of Chinese government bonds, the next thing would be that how can I sell it if there is no underlying market? So liquidity is also necessary. So if these things are not solved, then we cannot have higher renminbi values, and this requires capital openness. So again, we are opening the opportunity of, if we have capital openness, then we should have also flexible or floating exchange rate regime, because they are walking hand in hand together, which would create also appreciation in Chinese renminbi. So that's why I think that it's not an option right now. So we can see that there were some developments until they weren't.